Here's something every Apple investor needs to hear right now. One of the most beloved stocks in the history of Wall Street may be flashing a warning signal that too many people are choosing to ignore. Apple Incorporated, the company that turned a simple smartphone into a cultural institution, is currently forming what technical analysts are calling a risky chart pattern, and when you layer that on top of mounting concerns about overvaluation and the looming reality of iPhone price increases, the picture starts to look a lot more complicated than Apple's polished marketing would have you believe. Let's start with the technical side of this story. When analysts refer to a risky pattern in a stock's chart formation, they're typically pointing to price behavior that historically precedes significant corrections or periods of volatility. For a company like Apple, which carries enormous weight in major indices like the S&P 500 and the Nasdaq, a technical breakdown wouldn't just hurt Apple shareholders, it could send ripples across the entire market. That's the scale we're dealing with here. Apple isn't just a stock. It's a pillar of the financial system, and when pillars develop cracks, people pay attention. Now, the overvaluation concern is where this story gets genuinely thought-provoking. Apple's price-to-earnings ratio has been trading at levels that demand near-perfect execution from the company going forward. When a stock is priced for perfection, it has very little room for disappointment. Any misstep, whether that's a weaker-than-expected earnings report, slower iPhone upgrade cycles, or softening demand in key markets like China, can trigger outsized selling pressure. Investors aren't just betting on what Apple is today. They're betting on an idealized version of what Apple must continue to be tomorrow, and the day after that, indefinitely. And then there's the iPhone price increase conversation, which may be the most delicate piece of this entire puzzle. Reports and analyst projections have been pointing toward Apple raising the price point on upcoming iPhone models, partly as a strategy to offset tariff pressures and supply chain costs that have been compressing margins behind the scenes. On the surface, charging more for premium hardware seems like classic Apple, and historically, their loyal customer base has absorbed price increases with remarkable tolerance. But we are not in the same consumer environment we were 3 years ago. Inflation has reshaped spending habits. The middle-tier consumer, the person who stretches to buy an iPhone every 2 to 3 years, is genuinely more price-sensitive today than at any recent point in modern Apple history. If price increases begin to suppress upgrade demand, if consumers hold on to their current devices longer, or if the aspirational appeal of owning the latest iPhone starts to feel financially out of reach, then Apple's revenue growth story takes a serious hit. And a growth story that slows down on a stock priced for perpetual growth is precisely the kind of catalyst that validates those concerning chart patterns analysts are currently watching. There is also a broader strategic tension here worth examining. Apple has been aggressively expanding its services revenue, Apple TV+, Apple Music, iCloud subscriptions, precisely because hardware sales growth has natural ceilings. But services revenue, while impressive in its trajectory, has not yet grown large enough to fully cushion the company against a meaningful slowdown in iPhone sales. The iPhone remains the heartbeat of Apple's business model, and investors know it. So where does this leave us? Apple is not a broken company. Apple is not going anywhere. But the confluence of a risky technical pattern, elevated valuation metrics, and the uncertain consumer response to higher iPhone price points creates a moment of genuine vulnerability, and genuine vulnerability in the world's most valuable company deserves serious, honest scrutiny. The real question isn't whether Apple is a great business. The question is whether the stock price has already borrowed too heavily from a future that isn't guaranteed.